On June 12th, SpaceX begins public trading at a $1.75 trillion valuation, the highest price tag any company has ever carried into its first day. This chart tracks the valuation trajectory leading to the IPO. Just 11 months before the public was invited in, a private sale of shares valued the company at roughly $400 billion. But during that same window, total revenue grew by approximately 33%. The rockets did not get 4 times better in a single year, and the satellite network did not quadruple its capacity. While the business grew at a steady pace, it was the story surrounding the public listing that became 4 times more expensive. The price action in the opening days of an IPO of this scale is rarely a clean reflection of a company's worth. Instead, it is the result of a specific mechanical sequence, a relay where the excitement of the public listing creates the liquidity necessary for risk to be passed from those at the front of the line to those arriving last. To understand what supports that $1.75 trillion valuation, we have to look at the individual pieces of the business. In 2025, the company's total revenue was $18.7 billion. While the massive physical rockets clearly define the brand, the launch division itself is no longer the primary financial driver. Most of that revenue now comes from Starlink. The satellite internet service brought in roughly $11.4 billion, accounting for 61% of total sales. This diagram separates the divisions by profitability. Starlink generates about $4.4 billion in operating income. However, the capital-intensive launch business and the newly integrated AI division are currently burning cash, leaving a combined net loss of roughly $4.9 billion. Buying shares at the debut means acquiring one profitable engine that is currently towing several heavy loss-making divisions behind it. At $1.75 trillion, buyers are paying $94 for every single dollar of revenue the company brings in. For perspective, established and highly profitable technology companies typically trade at multiples in the low single to low double digits. In the public market, a 94-to-1 revenue multiple is an extreme premium for a net loss company that is heavily reliant on a single profitable subdivision. We can test the mathematical logic of this price by calculating exactly what SpaceX must achieve to make a $1.75 trillion entry point worthwhile. We'll start with a modest goal, simply matching the historical 10% annualized return of a standard passive index fund. To yield a 10% return compounding annually, the company's market capitalization must reach $4.5 trillion a decade from now. To justify that valuation, the business needs to generate approximately $566 billion in annual revenue. And that target assumes the market continues to grant the company a premium valuation multiple even as it matures. Growing revenue from $18.7 billion to $566 billion in a decade is a massive operational hurdle. It requires compounding revenue growth of 41% every single year. This pace would have to be maintained for 10 consecutive years without a single operational failure or a downturn in the satellite market. Almost no company starting from a $19 billion base has ever sustained that level of growth for an entire decade. At this multiple, investors are paying upfront for nearly flawless financial performance just to match the baseline return of a passive index. To understand why the price stays elevated despite these numbers, we have to look at the mechanics of the listing. The starting point is the official IPO price of $135, a price negotiated days in advance. It is a primary market transaction reserved for large institutions and a small group of insiders. This is where the separation of access occurs. The secondary market, where everyday investors participate, doesn't open until June 12th. Because retail investors cannot access the $135 price, their collective demand hits the secondary market all at once, overwhelming the limited supply of shares. This mismatch typically causes the stock to pop far above the $135 baseline as soon as trading begins. Mechanically, that opening pop is often the sound of institutions and early investors passing their risk to retail buyers who are paying that inflated premium. In the language of professional trading, those late-arriving buyers are providing exit liquidity. Historical data shows that first-day price action is often just noise. Look at the debut of Rivian. Rivian jumped 22% on its first day due to intense demand. 1 year later, the stock had fallen 67%. Reddit showed the opposite pattern. Reddit's opening day looked like a disappointment, with shares slipping lower early on. But since that quiet start, the stock has climbed nearly 150%. The opening day excitement doesn't provide information about the business. It only reflects the temporary mechanics of the listing. Retail buyers entering in the first few hours are often standing at the end of a liquidity relay race. After the IPO, two hidden forces can distort the stock's price. The first is index inclusion. Large index funds are often required by their rules to buy a newly public company once it reaches a certain size, regardless of its valuation. This forced price-insensitive buying can temporarily prop up a stock in the weeks following its debut. This creates a unique risk for everyday investors. If you hold an index fund in a retirement account, you may be automatically forced to buy the stock at an inflated post-IPO top. This artificial demand often aligns with a much more destructive mechanical force: insider lockup expirations. A lockup prevents early investors from selling their shares immediately. When it expires, they are legally allowed to flood the market with their low-cost shares. SpaceX's structure is specifically designed with staggered releases. Instead of one date, multiple waves of shares can hit the market shortly after their first quarterly earnings reports. The danger lies in the timing. The forced buying from index funds can prop up the price just as the lockups expire, creating the perfect exit ramp for early insiders to sell their positions. Once the initial retail hype fades and the forced index buying is complete, these scheduled waves of insider supply can systematically weigh down the stock. Navigating this IPO requires separating SpaceX's extraordinary corporate achievements from the mathematical reality of its entry price. A great company is not always a great investment, especially when the starting valuation already assumes a decade of flawless execution. For most retail investors, the most effective strategy is also the simplest: wait. Waiting allows the early mechanical distortions, like forced index buying and initial hype, to clear the market. Passing through the first few quarterly reports anchors the stock price to actual performance data rather than the engineered excitement of the debut. The market rewards the patient far more reliably than it rewards the early. To see more deconstructions of the mechanics behind the headlines, subscribe to Shreyas Finance. I'll see you in the next video.